The first half of 2022 has been nothing short of disappointing for investors across the spectrum, whether it be equities or fixed income. When I reflect back on the first half of 2022, I think a lot of the market activity has been driven by what I call the three peaks of pessimism. In particular, these three peaks include the sentiment around the general economy in the United States and Canada, the views towards inflation and the interest rate environment, and thirdly, the equity market activity that follows each of these first two. First, looking at the pessimism around the general sense of the economy in the United States and Canada, there's been a lot of talk over the last quarter with respect to the potential for recession. A lot of this stems around the central banks raising interest rates to fight inflation, but the data wouldn't yet support the risk of recession in the next 12 months. In fact, when we look at the unemployment levels in Canada or the United States, they remain at very, very low levels. When we look at manufacturing continues to expand, not only in the US, but other areas around the world. And if we look at the housing market, which is very important to the US economy, this still remains fairly strong, albeit we are seeing a moderation of economic growth over 2021, but there isn't enough evidence to suggest that we are headed towards a recession over the course of the next 12 months. The second peak of pessimism that we need to overcome is surrounding inflation and interest rates, in particular, central banks raising interest rates to stem the high inflation that we've seen so far this year. Canadian inflation came in at 7.7% on a year-over-year basis for the month of May, and in the United States, we saw inflation come in at 8.6%. These are levels that we haven't seen since the early 1980s, and as a result, central banks continue to raise rates fairly aggressively. Expectations are for both the Federal Reserve in the US and the Bank of Canada to continue to raise rates over the course of the year, getting close, if not slightly above, 3% for each of their respective benchmark rates. And that has created this sentiment of negativity around the fixed income markets. That has fed into the third peak of pessimism, which is the equity market volatility. In the United States, the S&P 500 that was in a correction in the first quarter extended that correction into a bear market by dropping by more than 20% into the second quarter. But it wasn't just the United States. We saw corrective markets in Canada, as well as Europe and other areas around the world. All of this has to do with the views towards the economy, the views towards inflation, and what central banks are doing. In my view, what we've seen so far this year has been more sentiment-driven as opposed to fundamentally driven based on the economic fundamentals in the United States, and therefore sets us up for what I think could be a better environment over the coming 12 months. Whether that be in the United States, Canada, or internationally, equity markets are much cheaper than where we were at the beginning of the year, and fundamentally still look attractive from an investment point of view. Investors would be well served to take the recession talk with a grain of salt until the data suggests otherwise. For the time being, the volatility might continue, but I believe that the worst of the volatility is likely behind us.